the Federal Reserve has once again made a significant move that could have far-reaching implications for the global economy: a rate cut. But what does this mean for investors and the markets? Today, we're diving into the details and exploring the potential consequences of the Fed's decision. A rate cut by the Federal Reserve means that they're lowering the interest rates at which banks can borrow money from the central bank. Banks can then pass this benefit onto consumers and businesses in the form of lower loan rates. This typically aims to stimulate economic growth by making borrowing cheaper and encouraging spending. However, rate cuts can also have unintended consequences, especially when the economy is already facing other challenges. One of the primary concerns is that a rate cut could lead to increased inflation. When the economy is already running hot, lowering interest rates can fuel demand and drive up prices. This means it exacerbates inflationary pressures because it increases spending, which leads to higher prices for goods and services. Additionally, a rate cut could also cause market volatility. Investors may become uncertain about the future direction of the economy and the effectiveness of the Fed's policies, leading to fluctuations in stock prices and other assets. Some investors may become hesitant to invest. The implications of a Fed rate cut extend beyond domestic borders. Changes in U.S. monetary policy can have a ripple effect on global financial markets. For example, a weaker U.S. dollar could make imports more expensive and exports cheaper, potentially affecting trade balances and economic growth in other countries. Changes in interest rates can also influence capital flows between countries. Investors may seek higher returns in countries with higher interest rates, leading to changes in exchange rates and potentially destabilizing financial markets. For investors, the Fed's rate cut presents both opportunities and risks. It's important to carefully consider your investment strategy and risk tolerance. On one hand, a rate cut can stimulate economic growth and lead to increased investment opportunities. On the other hand, it can also increase market volatility and uncertainty. Some investors may see the rate cut as a signal of a stronger economy and increased investment opportunities. However, others may be more cautious and opt for defensive strategies to protect their portfolios. Investors should also consider their investment goals when making decisions in response to a rate cut. Diversification and hedging strategies can help mitigate risks and protect portfolios. The Fed's rate cut is a complex issue with far-reaching consequences. As investors and consumers, it's essential to stay informed and understand the potential implications for the market and the global economy. Analyze key economic indicators like GDP, inflation, and unemployment rates to assess the effectiveness of the rate cut and its potential impact on the market. Consider the overall market sentiment and investor confidence. A positive market outlook can help offset some of the negative effects of a rate cut, while a negative sentiment can exacerbate market volatility. Incorporate insights from financial experts and analysts to provide a well-rounded perspective on the implications of the rate cut. Thanks for watching. Like and subscribe if you enjoyed this content. I post videos every week.